So there's many people who find it difficult to buy stocks, and there's also many people on the other end of the spectrum who want to buy a lot of stocks but find it quite expensive to buy multiple different stocks or even manage multiple different stocks. So is there a way you can own a variety of stocks in sort of one portfolio and just pay one price and have it managed from one place? Well, yes, that's what we're going to be talking about today: mutual funds, index funds, and ETFs. How you can buy this and what sort of person might be suited to buying a mutual fund, an index fund, or an ETF. Let's dive in. Well, a mutual fund is a fund with a collection of securities or stocks or commodities all into one. Think of it like a vehicle for investment. It's usually owned and managed by a fund manager or a portfolio manager. People pool funds together and pay it into the fund, and it's managed by the portfolio manager, where he picks and buys many different stocks into one fund, and that's what's traded. Who would typically buy a mutual fund? Well, someone who doesn't have the time to go and pick individual stocks. Also someone who would rather someone who's more experienced to manage the funds for them. Now, because someone is managing the funds, there is usually a commission fee for mutual funds. It is quite more expensive, the more expensive one of the three here today. But in the short term, mutual funds have historically been known to do better than all of the three because this individual or portfolio manager in this case can easily buy and sell stocks within the fund based on what's profitable and what's not, or what's doing better overall. How to buy a mutual fund? Well, a mutual fund is usually sold by a brokerage because they house the portfolio manager or the fund manager. An example of a brokerage here in Canada would be Wealthsimple, Questrade, TD Direct Investing, CIBC's Investor's Edge, and a few other options. Well, next up on our list is the ETF, which is the Exchange Traded Fund. An ETF, much like a mutual fund, is a collection of stocks, securities, and commodities into a pool. The difference between an ETF and a mutual fund is an ETF is traded on a day-to-day basis or on a stock exchange like a stock. So you can purchase an ETF on the exchange on a daily basis, unlike the mutual fund that is only bought and sold at the end of the trading day when the net assets have been calculated. Many day traders also trade ETFs just because of the ability to be traded on a day-to-day basis, which also means that you will be doing the buying and selling of the ETFs as opposed to a portfolio or fund manager. There are no commissions to be paid with buying and selling an ETF. Only the amount the trading platform would require that you pay, just like purchasing any other stock. Who would buy an ETF? Well, someone who wants to buy multiple stocks but also wants to do it on your own with the ability to trade stocks on a daily basis but not paying individual amounts for individual stocks as they go. I personally buy ETFs because I like trading on my own and I like buying multiple stocks. An ETF is a good option for someone like me who likes buying many different stocks but don't like the fees of individual purchases and don't like the management of individual stocks. Now, an index fund is our third one today. Is just like a mutual fund and just like an ETF, it's a collection of stocks, securities, and commodities. The difference between an index fund and an ETF or mutual fund is it targets a certain sector within the economy. Say, for example, you'd want to buy a bunch of energy stocks or a bunch of high performing companies or even small performing companies within the country. What you have to do is find an index that targets that sector of the economy and purchase that index. So the index would house all of the stocks or the majority of the stocks within that portfolio, and you can just buy that. But like the mutual fund, an index fund is only purchased through brokerages most of the time, and there's a commission, although not as much as the mutual fund, but not as cheap as the ETF. An index fund, like the mutual fund, is also purchased once during the day, which is usually at the end of the trading day when the net asset has been calculated and the price of the fund has been determined. Then it can be bought and sold. Now, who would purchase an index fund? Well, someone who's interested in a particular section of the economy or segment of the economy and doesn't want to buy all of the individual stocks within that segment of the economy. The person can buy an index in either energy or small companies or large companies within that sector, and they would own that index. Now, ETFs and index funds have proven to be more profitable over mutual funds in the long term because these stocks or funds are held quite longer than most stocks are, and they are the better choice for investors who would like a variety of stocks, who would like a more safer investment option. If you enjoyed this video, I want to please give me a thumbs up, leave a comment down below, ask me any questions that you would like to know. I will do my best to answer, and for now, thank you for watching, and I'll see you next time.